Welcome back. So I did a video on JAKKS Pacific a few weeks ago, right before, of course, it just fell off of a cliff. This has been a common theme with any stock I cover, so just write down the ones I cover and wait for it to crash and then buy it, right? Because what's happening is I covered it about 35, 36, and it dropped, almost in a third. It dropped, or more than a third. It dropped from 36 down to like 23, okay? Now, at this point, I actually bought some. And I felt like a genius because right after I bought it, they had this announcement about the preferred shares. And I was like, holy cow, I timed the bottom, first time ever. But that was short-lived, right? Because it's just been slowly going back down to where right now I think I'm at best break even. Okay, so anyway, I wanted to do a video on them, see if I'm missing anything. I'm really looking for some devil's advocate. So please comment, especially if you disagree. You know, I mean, look, I love positive comments too, but I'd love to get some feedback on why you think this might be a bad idea. All right, so just high level, what made it bounce back up after dropping was that they announced that they were going to redeem all of their preferred shares. So if you remember my last video, I'm like, look, I like the company, but I want them to drop to get to a more attractive price and start buying back shares. And like, that's like exactly what happened. It's pretty crazy. So I'm going to go to JAKKS Pacific Investor Relations tab and show you this press release that they had bought back all of their preferred shares. Now, wasn't exactly how I'd like it. I wish that they would have done all cash, but basically they spent $20 million cash and then they sold about $15 million worth of stock, which means it diluted the shares by about 5.5%. Now, so the hope is that getting rid of these preferred shares really frees up management to do things like buy back shares or pay dividends. I hope it's more buyback shares because they've paid down all their debt, right? This last buyback was the last piece to get rid of their 2019 restructuring. All right. One thing, just in general, whenever I'm buying a stock, my best winners, I don't know if you call them that, but like I've had the most success with turnarounds. So companies that either have had a management change or some sort of restructuring or something, and then they're, catching back up. That seems to have turned out really well for me. I think what happens is that if they're coming out of a bad situation, a lot of people still have a bad taste in their mouth, so they stay away. And usually new management and stuff is learned from the mistakes of previous management, Now, I think it is the same management with these guys, except for the CFO. But, they're doing all the right things, right? They paid down all their debt. Now they got rid of the preferred shares. So now all that's left to do is return value to shareholders, right? All right, well, we're going to get to that. So real quick, I'll just go over their fourth quarter presentation, some of the highlights. All right, so this is their fourth quarter earnings presentation. I'm going to scroll all the way down here to the sales growth. So yeah, right here, full year net sales growing at about 4.5% per year. Okay, now they did have the big spike in 2022 and then coming back down, but still. And they started 2019 because this is where their restructuring took place, right? All right, and what makes that even more attractive is that gross margin is actually higher. So I think that it's probably not going to stay at 31%. I think that it has a lot to do with the previous low of 2022. So, if you take the average of those two, so let's just see, 31.4 plus 26.5 divided by 2, you get that 29% where I think it's going to, that stays, right? So anyway, I think that that's the gross margin moving forward. But I could be wrong, right? Maybe they stay on that 31%. One other thing I thought was interesting. So EBITDA, all right, adjusted EBITDA. I hate EBITDA. I hate adjusted EBITDA. But the reasons I hate EBITDA is that I don't like subtracting interest, the I, and I don't like subtracting depreciation without at least subtracting CapEx. But this is a company that has no debt, right? They've paid off all their major debts, so their interest is going to be nothing. And then there are really low capital requirements, right? We'll look at their CapEx, but they require less CapEx than depreciation. So I'm okay looking at EBITDA. I'm not going to use it for my own valuation, but just the big thing is the trajectory, right? Any form of earnings, which you use what you want to use for your valuation, you should just be using cash flow, right? Free cash flow. But what you want to see is that whatever metric they're using is going up, and it is, right? So we're sitting at about $76 million a year of adjusted EBITDA on a $251 million market cap. I mean, that's crazy. Think what that yield is. And I could do it to enterprise value, but I don't think they have a lot of debt. I don't feel like looking up the total debt right now, but $76 million EBITDA, 251 on the market cap. I mean, that's a 30% yield. Crazy. All right, scrolling down. Look, this is a quick overview of their products. So basically, they have the license to make toys for these different product lines. So they make some Disney princess toys. I have one, or my daughter has one that she loves. It's a little fake iPad thing, but it's plays princess sounds. And then just a lot of these movies that are coming out. So they talk about looking forward to Moana 2 coming out. But in addition to that, they really also focus a lot on their evergreen products. And I'll show you, they have that at their last slide. So their evergreen products are things that are just going to be solid, that they don't need this big swing. Like up here is the content-led action plays. So those are going to be really dependent on movies. You can see their evergreen side is just continuously growing, right? I mean, 263, 360, 382, and then almost 400. So, all right, that's enough about the company. I want to go back to the financials, and I'm going to start with the balance sheet. All right, I'm not sure if I went over this in the last video, but I mean, this is just what I love seeing, right? Tangible book value growing. I mean, any company you own, I would say you want this growing unless they're just spending a crazy amount on dividends or share buybacks. But even if it's share buybacks, you'll see tangible book value per share growing, right? So that's really good. The one concern I have on the balance sheet is this ordinary shares number. So they're just slowly diluting shares, and next quarter it's going to be even higher because they diluted those shares to pay off the preferred. But the hope is that the money that they're generating, it's going to start coming back down because they're going to be able to use money to buy back shares, right? So that's the balance sheet. Let's go to the cash flow statement. Okay, so this is cash flow every quarter, free cash flow every quarter, going back to 2019. And one thing I like to do is look at, the last several quarters, let's say 8 quarters, and see if it lines up roughly with net income, just to make sure everything's okay. I just summed these and I got $133 million. So for 2 years, they made $133 million of free cash flow. That's a crazy yield, right? 133 divided by 2. So $66 million in free cash flow. That's what I mean about counting that EBITDA number, because that's pretty close to that $76 million EBITDA. And the reason is that CapEx is low and interest is low, right? So that's a really good free cash flow yield. $66 million on $250 million market cap. That's crazy. All right, so that was going back to what I was going to do originally. $133 million was the free cash for the last 2 years. I like to go compare that to net income. So I'm going to go to the income statement real quick. Not revenue, net income. And just sum the last the last 8. And I get 129. So last one was 133. This one's 129. They're in the same ballpark. That's really all I'm looking for. What I'd hate to see is high income and low cash. That worries me. And the reverse the reverse is better if I had to pick one, but at least whenever they're both the same, it makes me think, okay, things are checking out here, right? So anyway, let's go back to the cash flow statement, because I like to adjust this free cash flow for stock-based compensation. So where I have adjusted free cash flow here, that just means free cash flow minus stock-based compensation. And then I'm going to actually take it on a trailing 12 months basis. So I'm going to do it like this. And all right. So this means I just sum the last 4 quarters every quarter. All right. And look at this cash flow. Okay. So you're talking 80 to, $50 million a year in free cash flow. I mean, that's super strong. I'm going to pull up my DCF and I'm going to be even more conservative. Watch this. So what I'm going to do is put $40 million in the free cash flow. And I'm doing 40 even though the last 2 years they did 65 on average, right? So 40, I'm going to put a 5% growth for the next 5 years and then 3% perpetual growth. So even with what I think is a very conservative number, I get a net present value that's 354, which is about 40% higher than the current market cap. Now, with a margin of safety of about 2/3, wanting to buy it at 2/3 that, you'd have to wait for $240 million market cap, but I really don't think you need to wait for that. I mean, just look at this asymmetric upside. So like, let's say I put 65 here, which is what they averaged, right? 65 here makes your target entry price way higher than the current market cap, and it makes the net present value more than a double. Okay, so 574 divided by 251, I mean, that's 2.3 times. So, I mean, you're talking about the potential for, a huge upside, and then I think some really strong downside protection because you have a great balance sheet, meaning no debt, and they do have some evergreen product base. Now, I'm going to take a second here to go over the bear case, and I asked you to put it in the comments as well, but the main thing is I can just hear Charlie Munger just beating down, this is a retail company, and retail sucks. And the reason retail sucks is that unlike other industries where you have to be smart once and then you make a great product and it just sells itself, retail, you have to be smart every year or really every quarter. I mean, you have to constantly be staying ahead of the competition, making better products, not trying to lose market share, that sort of thing. I mean, it's vicious in retail, right? And everybody's copycatting each other. I totally understand why it's not a great business. And that does give me some pause. I just think it's probably a little too cheap right now. The other thing that gives me a little bit of pause is that they haven't started the share buybacks yet. Now, they did all the right stuff up front, pay down all the debt, get rid of the preferred. I'm kind of banking on them starting to do the share buybacks, right? And I'm going to go back to my financing cash flow to show you what I'm talking about. They were spending going back to 2019, they've been spending an average of like $8 million a quarter. If I averaged all these and I got like $8 million a quarter in financing cash flow. So if they don't have any debt and the preferred's gone, like, what are they going to do with that $8 million, right? So I'm hoping it still goes out in financing cash flow, and there's only two paths left, right? Dividends or stock buybacks. A dividend would be yielding you, so 8 million times 4 divided by 251. I mean, if they paid it all out in dividends, it'd be like a 13% dividend. That would be crazy. But anyway, that's just me kind of doing some off-the-wall math, right? So that's my thoughts. Like I said, please give me the negative feedback, not on the video. I mean, you can if you want, but I'm talking about on the stock itself, right? So give me what you think is the bear scenario, why I should stay away from this. Anyway, that's all I got. I hope you enjoyed it. I'll see you next time.